promotional material, whether it's webinars like these, videos on the YouTube channel, or any other promotional material via email or any other means, is for educational purposes only. All the webinar recordings are uploaded to my YouTube channel. Kai, if you could just let me know whether you're recording this or not, that would be great. As long as it's being recorded, I will load that to the YouTube channel. Okay. So the upload to the YouTube channel. If for some reason you don't receive an email with the recording, check your spam or junk folder for contacting me. All right. If after registering for a webinar and you check your spam or junk folder and you still haven't received the links, send an email to me directly. Okay. So my assumption today is that this is being recorded, and as long as it is, it'll be on my YouTube channel. So just to start out with a little levity, I just want to ask, how is your trading? I put up a picture of Bugs Bunny. I used to get a kick out of him as a kid, and one of the things that he used to do is, when his it didn't really matter who he was up against, he would always kind of show up. Some guy's hanging off the edge of a cliff, and he would just kind of come up and be chomping on his carrot and say, how's it going? Or what's up, Doc? So I just want to, use the Bugs Bunny example and, ask how your trading is, right? Some of you are, hanging on the edge of a cliff, hanging on by a thread. Some of you are doing quite well, and some of you are kind of, you just need that extra little push to get you back to the point of profitability. So usually we find that there's three categories of traders who have the NOFT. You're either consistently profitable, looking for refinements or enhancements to your current trading regime. Okay, so we've actually had traders that are consistently profitable, come in and start using the NOFT, and their profitability goes up significantly. Not to mention that, a lot of what we focus on is reducing risk and controlling risk. And a lot of traders find that when they start using the NOFT, they're able to trade with a lot smaller stops. The second category of trader that we find a lot is the break-even trader. Those are usually frustrated, looking for something to help them to get into profitability. This is, I guess, what you would call the edge of greatness. You feel like that, if there was just something that you could add, or just some concept or some indicator, or just some way you could tweak your trading, that would take you from break-even to profitability. The biggest challenge that most people have at the break-even stage is, well, I hate to throw cold water on people's faces, but the reality is at break-even you're still losing, simply because of the time factor and commissions. If you're sitting there still losing or still break-even, eventually the commissions are still going to eat you up, eat up your account, and this can be the most frustrating stage for any trader. If you're still losing, this is where most of the people are in their trading, and that's, you're either really not sure what's going on or what to do, and in the early stages of still losing, you're usually still searching for the Holy Grail. So whatever your category, the NOFT can definitely help you. Yeah.
Can I talk about the Holy Grail?
Yeah, that's the NOFT, right?
Yeah. No. The holy grail in trading is really taking advantage of the 90% of traders out there who aren't reading the market correctly, who learned it through, or applying, moving averages and oscillators and candlestick patterns and things of that nature, which are great for longer term trading, but they apply that to day trading. And they call that price action. When they're saying, oh, I'm trading price action by taking the close of a bar against a previous bar and going long or short. And that's not price action. That's trading an indicator. Candlesticks are an indicator. What you need to understand is and look into are the numbers that constitute and make up that supply and demand within that time frame that you're looking at, whether it's a 5-minute candle or 15-minute candle, whatever has you. The Holy Grail is, and in breaking through consistently, being consistently profitable, is all about managing risk first. It's not about trading more and increasing your commissions or those fees. It's not about taking larger positions. It's all about managing your risk. And managing your risk is all about getting in before 90% of the other traders are getting in. So you want to get in the you want to get involved in the direction of the larger players, but you also want to get in ahead of everybody else that's waiting for the bar to close. So with the NOFT, you have enough viable information to lean off of, whether it's the block trades or the ghost blocks or the trade imbalances or the stacked imbalances, inventory levels, or whatever you want to use, the standard deviations. So we really want to open this up and, ask the questions about, what part of NOFT can really help you. There's so many different pieces to the NOFT, but it all comes down to the Holy Grail is getting involved early, not over trading, not taking on too much risk. So let's focus on that during this session, and then you'll be able to ask yourself, my trading's just great, and you're taking that next trade because you see the risk, and the risk is manageable, not based on an oscillator or something to tell you to get in. You're getting in because of real live data and information. So I just wanted to point out there is a holy grail to trading, and it's taking advantage of the 90% of the losers out there.
Yeah, because exactly right. Because as I mentioned, this is still losing. That's the greatest number of people, and so if you can take advantage of that, you can have an edge, and that's what trading's all about. And it's funny that Kai mentioned candlesticks and getting in ahead of those people that are still trading that way. And I actually have a perfect example of that from what's today for most of you, Monday's trading session. I have a perfect example of that. So we'll get into that in the next couple minutes here. Basically we're trying to cover in this webinar the 5 W's, who, what, when, where, why, sometimes how. And basically, this toolkit was developed by Kai. He's done, most of you know his history. So if you don't, he did quite a long stint on Wall Street with different firms. And then basically he teamed up with Ninjacators. Ninjacators is the biggest provider of indicators for the NinjaTrader platform. And so he teamed up with them because well, let's get into why. What is it, first of all? It's a software tool for any transparent, electronically traded market that displays important, unique, and I like to say hidden information within the volume of any instrument. And so why was it created? Well, it was created because there was a need to display that important information in those trading concepts that were not being displayed or made available in the retail trading market. And we come from the belief, I myself included, that retail traders are taking on way too much risk and using way too much leverage, and it's just not necessary to take on that kind of risk or over leverage yourself in order to be profitable. It also came from the belief that retail traders are too random in the way they determine their stops and targets. People will say, well, oh, okay, I have a 10-tick stop, or I have a 12-tick stop, or 15-tick stop. Why? Is that just, what is that? Is that based on some definitive information, or is that just random because, okay, well, I'm trying to make my trades 2-to-1 risk reward, so I'm going to take a 15-tick stop and go for a 30-tick target. Well, that just doesn't make any sense. That's random, and here we do not believe in random. I actually was on the line 2 days ago with a gentleman, and he's asking me and kept hammering that at me. Well, what's your initial stop, and what's your initial target? And I just told him, we don't do that random. It's going to be based on what the information, that hidden information that was hitherto unavailable, or at least was not available in the format that the NOFT presents it. It determines if I get into a trade, or any of the people that are using the NOFT get into a trade, we have a stop based on logic. We have a stop based on actual market-generated information, and we'll trail the stop accordingly. And if that market-generated information changes, well, we're obviously either going to exit the market or trail our stop in much tighter. If I did have a reason that was based on market-generated information for a specific target, well, I'm going to go for that target. But if on the way to that target something changes, well, I'm not going to just keep that random target, and I'm not just going to keep a random stop. That doesn't make any sense. And that basically comes down to, another point of the NOFT was to properly teach retail traders how to manage risk, and in addition to that, recruit talented traders for the launch of our prop firm.
Can I add something to that as well?
You want to add anything to that, Kai?
Yeah, sure. Remember that the market, we want to trade the market-generated information. We don't want to trade biases. We don't want to trade, randomness, random numbers, right? The market does two things. The market is a distribution system that seeks out value. And it goes from value to value, from high value to low value. And it's going to do so in a form of being balanced or equal, and imbalanced, unfair, right? And when it's imbalanced, it's going to spend less time at price. So there's no value. So therefore, it's searching for value. And what you want to do is the NOFT prepares this information, the algorithm in the order flow sequence tracker, prepares this information chronologically so that when you are in a trade, and if you are finding imbalance occur, you're going to stay with that trade. As soon as that imbalance is offset by the other side, then it becomes a value, and the market will pause and trade and basically turn around a price level. And it's either at that point going to continue, or another large trader has to come in and create that imbalance once again, or it comes back down to value. And so you want to be able to see that information as soon as it's available. And as soon as you see an imbalance become balanced, your risk becomes higher. Your risk is that there's no longer an imbalance. That's all of a sudden the price that's there becomes a fair price, and therefore you lose your edge. And trading is all about the edge. And again, it's the edge. Your edge is the 90% of losing traders out there. Any questions about that? Does that make sense?
Makes sense to me.
Okay.
All right. So we haven't been doing this for very long. I believe the NOFT was created in 2013 and was first available to the public in early 2014. Some of you may be aware that we've recently had an update that was just in January of this year. So, you know, we've covered the who, what, when, where, why, etc. And you know, I basically have some assumptions in this webinar that you fall into one of the three categories. All right. You've been trading for a while, probably 2 to 3 years minimum. You've heard or know what a footprint chart is. Okay. You've heard or know about concepts such as cumulative delta, volume profile, and others. Okay. So, you know, this is just your standard candlestick chart, and one of the themes, the kind of the slogan for the NOFT is "Look inside the market." You know, this candlestick chart, it's fine. I can see different patterns on there, and I'm sure any of you guys who have been around for a while can see different patterns on there. You've got dojis in different places. You've got you know, inverse hammers or hangmans, bullish or bearing engulfing patterns, whatever. Okay. The biggest problem with a lot of those patterns is that, again, it goes back to controlling and managing risk. If you look at this, this chart here, you know, if I decided to go, let's say I decided to go short based on this, you know, this is obviously a rejection here. You got this long wick of this candle here, and it's a red. It's a red, obviously a candle that closes lower than it opens. And you know, previously you've had a doji, and previous to that you kind of had a, I guess you could call it a spinning top. All right. And so you get this kind of this heavy rejection candle. Most traders are going short at the close of that candle, or they'll try to do some arbitrary thing like a Fibonacci level. They'll try to go, you know, okay, I'll go in at if it retraces to 23%, I'll go in, or I'll retrace if it retraces to 38%, I'll go in, or 50, or 618, or 76, you know, 0.4, whatever. But the point of that is that in almost every one of those cases, you're taking on too much risk, and you're not entering based on logic. You're not entering based on market-generated information. And what the NOFT is going to do is it's going to tell you, it's going to show you where the high probability entry is, and where you should be placing your stop based on that. Okay. So you know, this is just a standard footprint chart. All right, and to be able to read all these numbers and do it in real time, that is a daunting task. And part of the reason for the development of the NOFT is to make this easier for you, okay? And to point out the relevant information, to highlight the imbalances that Kai was talking about. And based on those imbalances and the other important information that the NOFT will display, to be able to give that to you in real time and give it to you in a very visual format so that it makes sense. Okay. I'm just going to exit out of the presentation now and actually look at the NOFT on an actual live chart right now. Okay. We may come back to this later. I just want to exit that. All right. And this will be good for anybody who has the NOFT because there's some recent additions that I'll also highlight during the rest of this webinar. So we're about halfway through right now. Any questions before we continue any further? Just grab a quick sip of water here and wait for you guys to type if you have any questions. Okay, let's keep going then. All right, so you should be seeing the screen of the ES, the S&P E-mini March contract. This is a 5-minute chart. Okay, so this is Monday's action. Monday, President's Day, it was a holiday in the U.S. And what I want to bring your attention to is a couple things. First of all, as we come up into this 2093 area, you start to see some highlighted numbers. And those highlighted numbers are the imbalances. Okay, they're highlighted in red. And what are the imbalances? Okay, what they are is it's a way for us to measure aggression within the tape, within the volume, to see who is being aggressive, the buyers or sellers. And then we can highlight that, and as with most things in the NOFT, everything is customizable. I've just chosen to highlight the sell imbalances in red and the buy imbalances in blue. So we come up into this 2093 area, which, by the way, is the previous day's high, right? And which is denoted by this green line up here. And you start to see red numbers show up. That means sellers are being aggressive, okay, relative to the buyers. When we come into this area, you know, you get a big seller, 496, and then you get an aggressive buyer, a 255. Well, that's, you know, that's almost just a little over half as aggressive as the sellers. And the way we compare it, the way we measure it, is basically we're doing it by a percentage. So if I go into the NOFT settings, the order flow sequence tracker, that's the main engine. If I go in there and I go to trade imbalance, okay, the threshold I've got set is to 300%. Okay, so basically it's measuring whether one side of the market has 300% more contracts than the other. All right, so basically one side has to be 3 times greater than the other side, and it's measuring that diagonally. So in other words, if we look at this imbalance here, it's 96. Well, it's not measuring 96 versus 0. It's measuring 96 versus 12. Okay, so it's measuring diagonally. So obviously, you know, 12 times 3 is 36. Well, 96 is much greater than 36. So that's why you're getting the red numbers show up. And so that's imbalance, all right? So it's measuring aggression, and it's displaying it to you in a visual format. In this case, it's highlighted. You can also, just go back into the settings for a second, you can also make the font size for the imbalance. You can actually make that greater and change the font style, whatever you want. You can bold it, you can underline it, italicize it, whatever you want. You can do that. So basically you set that to true, and then it's going to show your imbalances, and you decide the threshold. Okay.
And can I point out that?
So that's trade imbalance.
Let me point out that you know, when it's live and active, you know, the trade imbalance can be offset by the other side, and once it is, it goes to a neutral color, and neutral color right now is black. Otherwise, it's blue for buys, more aggressive, or reds for sales. So one of the things you'd like to do here is you would like to have the S&P come up towards where are those trades, where their sellers initiated trade, where they initiated large enough contracts to send the market down. Then as you can see the response of buyers coming in here, and it takes it higher back up towards that 91.5, 92, where they initiated that trade, you will want to see them respond, responsive selling. And when you see that responsive selling, you're not going to want to see neutral numbers at that level. You're not going to want to see blue, you know, highlighted blue numbers either. You're going to want to sit there and wait until you find a trade imbalance to the sell side. You want to have The folks that came in at 12 o'clock and initiated those sales, you want them to sell again. And that's when you want to get on. And you don't have to wait for the close, because that will automatically be calculated with the OFST algorithm on whether it's creating an imbalance or whether the initiative sellers are actually responsibly selling. So it's done in real time. So therefore, your risk is mitigated. And again, you're getting in before 90% of the crowd. That's the real benefit of using this trade imbalance.
Yeah. Any questions about that? And I would just add, that what Kai is saying it makes complete sense, because, as I mentioned before, that green line right there, that's actually the previous day's high. Okay. So when we came up into that same area. Okay, that same area that formed the exact price level, in fact, that formed the previous day's high. All of a sudden, all this aggressive selling comes in. Well, using the NOFT, you're not going to get trapped into taking the breakout to newer highs, because you see this information. You say, wait a second, we're coming into the previous day's high and we get aggressive selling. There's no way that you're going to be looking to trade a breakout, okay? Because it's just not going to happen. And so what you're seeing there is that aggressive selling come in at the previous day's high. Well, you know that there's not enough juice to make the market go higher. Now, one of the things that I've talked about a lot in these webinars is the fact that you don't have to chase trades either. And if you look, and again, we're just looking at imbalances right now. We haven't even gotten into things like block trades, etc., which we'll do in short order here. But the market goes down, and then you get the first reaction. You get a pullback, and where does it pull back to? Well, if you see this area down in that big bearish candlestick, okay. This is actually the candlestick with all the numbers displayed in it, okay? All the volume on either side of the market displayed in it. So this big bearish candlestick that went down, you have a whole bunch of aggressive sellers stacked together, okay, on that 12 o'clock bar. And so you can reasonably expect that the market is not going to go above them. And if it does, maybe by a tick before it continues down. And that's exactly what happens. We come up to the second last sell imbalance, and the market continues, okay? And so there's about 4 points, almost 4 points in there from there, okay? So, well, okay, that's great, Jay. Well, where's my entry? Anywhere in here is an acceptable entry, because what is your risk? As I said, one tick, give it an extra tick just on the other side of that imbalance, what we call a stacked imbalance, all those imbalances stacked together. And so your best case scenario is a 3 tick stop. Your worst case scenario is a 6 tick stop.
But if you take the same example,
when it comes to managing risk,
if you take the same example that I was talking about, waiting for it to go up to 91.50 or 92, which was that block up there of stacked imbalances, and let's say obviously it didn't get there, but the same thing occurred here. From the 12 o'clock bar, there was trade imbalances 1, 2, 3, 4, 5 deep, right? Those are the sellers they're still initiating, even at lower prices, so they're still being aggressive. So as it comes into that 12.10 bar and then retraces back up, and in that 12.15, 12.20 bar, that is exactly what I'm talking about. You would wait for that trade imbalance to show up again. That would mean that the sellers from the 12 o'clock bar that initiated the sale are responsibly selling at the 12.15 and the 12.20 bar. So you can take that trade with very minimal risk. See that 5 by 204 and that 140 141 by 478, you take that one tick beneath those, and you have your stop above that 2089, which is that trade imbalance of 130 on the 12 o'clock bar. And you see that that becomes a new level. That means that they are accepting these lower prices now. So now you can look for a continuation short versus a reversal short. But mark my words, tomorrow or later this evening, when you come up through 2190, 2091.50 or 2092 to test that high at 2093.75, you're going to look for the exact same thing. And if it shows up with a trade imbalance, you'll go ahead and short again. So that's how simplistic it can be. You don't have to guess anymore. You don't have to test your money. You can wait for others that can move the market 3 to 1, 4 to 1, 5 to 1 versus the other side. Wait for them to initiate the trade, and then you just ride their coattails. That's what trading is all about.
Yeah, absolutely, and it actually it leads in very nicely to the next aspect of it, what I'm going to talk about next. Part of the order flow sequence tracker, we have, the iGhost block indicator. What we have is actually an indicator that will show when those imbalances are stacked together, and so that's what we call the stacked imbalance. So now if I go and put stacked imbalance on my chart now, which we can toggle up at the top, this is actually drawing zones now, showing us where the aggressive buyers or sellers were stacked together, one on top of another or greater. And so if we go to the settings, you can actually determine whether or not you want, I've got it set to 2, you can set it to 3, 4, 5, however many you want stacked together, either aggressive buyers or sellers, in order to draw a zone. So you don't have to actually be looking for that exact, or looking at those numbers specifically. When we come out of a zone or come back into a zone, then you start paying attention. Okay, if we're not in the zone, well, you need to sit on your hands and wait. When it comes back into that zone and then rejects, as Kai said, you get that aggressive selling showing up again, then there's your opportunity. And what's funny is we come up again into the same zone later, half an hour, 45 minutes later, we come up into the same zone again after making a lower low. We come in and retest that, and it retests exactly to that very last sell imbalance in the stacked imbalances, that 130 back on the 12 o'clock bar. We come back exactly to that last one. And so if your stop was just on the other side of that, or even an extra tick above it, you're in this short, again, with very low risk. And what happens? We make lower lows, and from that point, we're talking about 7, 8 points down from there. So the NOFT just makes it easy. It makes it logical. Okay, there's no guesswork. You know where the sellers should be coming in. All right, and if they're not, well, then maybe you're not looking for a short. Okay.
A successful trader is an efficient trader, and this is a mark of efficiency. And first, you have to understand what we're looking at. And what we're trying to do is we are not battling against the professionals. You can't win. You will not win. They have more money than God. So you might as well stop fighting it. So you wait, and you can see with this information clearly. First you have to understand, what is it? So the fact that large institutions can't sell everything they have at one price means they have to piece it out in multiple prices or over time. So you will notice that when you start looking at this information, you'll start to see that they'll start hitting it around the same price. It'll retrace up, they'll hit it again. That can tell you the size or that can tell you the size of the fund and what their real purpose is, what they're really trying to do. And there's nothing else out there in the retail space that shows you this with this type of efficiency. Nothing. The only way you know about this now is because I've actually been on that side and done that. I had positions large enough to where it took me weeks to sell it because I could crush the market. And if I crush the market, well then I'm reporting a bad price to the client. And I'm not doing my job. And I won't get the rest of the buyback or something like that. So it's all about understanding the market, understanding its purpose, understanding why it's there. It's not there to take your money. It's there as a distribution system for these large institutions and governments and commercial traders. And you need something that's efficiently tracking all of this information in real time so you can take advantage of it.
And so, in keeping with the theme of taking advantage, if you look at this 1255 bar, all right, another aggressive down bar, all right. Well, look at what happens on the 1 o'clock bar, which by the way was the close yesterday. Okay, so even at the close, even when the market closed, it respected these stacked selling balances up here. You got 54, 67, 60, 100. Now if I put the stacked imbalance zones on again, you see that. Okay. All right. So it respected those levels. The market opened back up for the Asian session, and we actually had a little gap down actually, and the market comes back up, and where does it come up to? It comes up to this stacked sell imbalance here, this 81 and this 112. Okay, let's take off the zones just for a second. So that's in that big down bar, they were the biggest. That was the biggest sell imbalance, was the 112. Okay, and we come up there, and again we sell off from that point. Okay, so you start combining these aspects. This is market generated information, and what we mean by that, it's generated from the volume. Okay, and it's logical that if you're entering at this 112 or at the 81, somewhere in there, it's logical that your stop should only be 1 or 2 ticks above that level. So there's no need to take on any kind of big risk in order to participate. And so far it hasn't been a big move, but I mean, it's the Asian session. Usually the market doesn't move by leaps and bounds during it, but hey, there's a couple points in here available to you. So that kind of leads into the next thing that I wanted to talk about, and that's what we call the reversal alert. Okay, what the reversal alert is doing, and for those of you that already have the NOFT, if you're not familiar with what this is doing, this was part of the recent upgrades, okay, that came in January. This box on top of the on top of price, okay, this shows up in real time based on a sequence within the tape, okay, within these numbers. There's a certain sequence and certain criteria. You can go into the order flow sequence tracker and adjust that all on your own, okay. And they've got different aspects. You can up here, higher high, lower low, previous bar rule, all these different things. I'm not going to go into exactly what those are, but you can adjust the different settings. And again, in this particular instance, if we put the stacked imbalance zones, you come into an imbalance zone, you come to the level where that 112 is and that 81, okay, back on that 1255 bar. We come up in there, and then we get a reversal alert that's with the trend, which is obviously down, we get that reversal alert, that makes sense to take a trade there. Why? The risk is low. Okay, the risk is low. If we're wrong, pardon me, not long. If we're wrong, the market is not going to hurt us. All right, it's only going to if we get stopped out, it's only going to stop us out by a couple ticks. Okay, so those are the high probability setups that we look for, and and that's the name of the game, is we're looking for those high probability setups with low risk. Okay, any questions? All right, so basically we've gone over two or three indicators or aspects of the NOFT included with it, including the new upgrade. And I think that in terms of going over the indicators, we'll probably just leave it there. We do have some. I'll just quickly go over some newer ones that we have, which are the. I'll just throw up the. We also have in addition to the algorithm that I just showed you, we've also got a trading range indicator, so I'll just put that on the chart. So just give it a second, and just take a second for it to load up. Got a lot in the chart, and I believe there's over 15,000 lines of code in the order flow sequence tracker. So it's taking a minute to load up here, especially on an instrument like the ES. I've put my email, the Skype, the order page, and the YouTube channel in the chat again as well, just so you guys have that as we wrap up here. Yeah. So the trading range indicator, if you look at the top of the screen there. It's actually giving you what the range is, and you can set that to whatever you like. So it's telling us that over the last 20 bars, the range has been 9 ticks. So obviously during the Asian session, it's not a heavy range there. So I like that because it gives you an idea on any market where we've been over the last X number of periods or bars. So only 9 ticks. Yeah, the market it's not moving right now. You probably want to stand aside until that range.
I like to work with
extends.
I like to work with within 45 minutes at the most. I want to see at least 30 ticks range, because I'm looking to take the bulk of that range, that bulk of that opportunity. What this is telling you here is there's no opportunity here within 9 ticks. You'd have to be an awfully amazing algorithmic scalper to make some money out of a 9-tick range in the last 25-minute bars. And that, again, goes back to, not over trading, knowing when to take a trade, knowing what to look for, knowing the probability of success. And part of that probability of success is, are you trading at the right time? Is there enough range within the time frame that you're looking to trade? You can put on a trade, but you can't expect to be successful here with only 9 ticks unless you have a longer holding time. So again, you can adjust that based upon that information.
Yeah, exactly. Funny you mentioned about an algorithmic scalper. If we look on that 645 bar, that was the algorithm fired off, and that was probably your best chance. That was probably your best trade opportunity during this Asian session. So that's funny. But yeah, you want to take your trades when the market's actually moving. All right. So we've looked at the trade imbalance, we've looked at our stacked imbalances, we've looked at the new algorithm, we've looked at the trading range indicator. We've also added what we call the NOFT VWAP, okay? And I'll just throw that on the chart.
I'll set this up. Volume weighted average price was a grade it was a measuring stick that we were graded upon. So VWAP is the average price, volume weighted, of course. So how we would report back our trades to the client is we got such and such off at plus or minus so many points or ticks better than VWAP. VWAP was considered, if you reported back VWAP, that was considered like a C grade. If you reported better than, you obviously are doing your job. If you reported worse than VWAP, then, if you continue to do that, you're at risk of not receiving that institution's, orders the following day or more orders for that day. So it's always a competition. So what you want to do is you want to have your eye on where the institutions are being graded, which is VWAP, and then the standard deviations away from that VWAP is where you can better your average. And so that's what we would do. We'd become speculators when prices moved away from the VWAP. And if we were selling, we would be obviously looking to resell as it retraced back up towards VWAP. Or we could speculate and get long as it moved 2 standard deviations or 3 standard deviations away from VWAP, both to the top side and the bottom side. And so that's the purpose behind having this information. Once again, you have to know and ask yourself this question every single day, every single moment you're about to put on a trade. Who is in control? Okay, we see sellers have initiated trade to the sell side. They're in control. Where is value? Value right now in the VWAP is 2089. Where's price in relation to value? Are you selling and it's 2 standard deviations away from VWAP? So that means it's too cheap. And therefore, if it's too cheap to sell, there's the other side that will be buying. And you don't want to short when large traders are buying. You always want to stay with who's in control. Those are 3 questions you always have to ask yourself. Who's in control? Where's value? And where's price in relation to value?
And the funny thing is that the concepts that we're talking about here, and that Kai just mentioned, if you look at where that big sell-off started yesterday, again, you start gathering, think like a lawyer or a police officer. You're putting the evidence together, okay? You're putting the case together. Okay, so you come up into the previous day high. Okay, well, that's obviously going to be a point of interest, okay? You start seeing aggressive selling show up, okay, in these bars. You're up into the 1 to 3rd standard deviation, okay, you can see these zones, the deviation lines that are from the VWAP. The VWAP is the black line here in the middle, okay? So you've got 1, 2, 3 standard deviations away from that. So you're in the 3rd standard deviation. So going back to what Kai was saying earlier, the instrument, okay, the commodity, whatever market is, it's expensive right now, okay? So do you want to be buying when it's expensive? No, you want to be selling when it's expensive. You want to be buying when it's cheap. And it's funny how, you know, these aggressive sellers come in, and if we put the these sellers come in up in this third standard deviation, okay, on the positive side of the VWAP, and what happens? We go down to the same thing. We go down to the third standard deviation, or almost the third standard deviation in the VWAP. We're in that third standard deviation zone, okay? So now the market is saying, well, this is this is cheap now, okay? And that's why you get some of the buyers showing up, okay? When we come into that zone and we come down into it again, buyers show up again, push it higher, but they can't hold it, and then we continue down. And where do we continue down to? Exactly, it looks like we came with exactly to the tick, or within one tick of the third deviation outside line there. So, you know, build a case for your trades, okay? As Kai mentioned, who's in control? Do you have aggressive sellers or aggressive buyers? Do you have stacked imbalances? Where are you relative to value? Where are you relative to the VWAP? You know, which zone are you in? First, second, third standard deviation, all right? You know, what's the range been, all right? 9 ticks right now. I don't think I want to participate in that, okay? But if if your range is 20, 30 ticks, maybe that's something that you want to participate in. But do it with an edge, okay? So we've gone over some of the newer aspects of the indicator. I think we'll leave the presentation at that. I'll just go back to the slideshow just for a minute there. All right, so why do you need the NOFT? Obviously, you can use it to accurately interpret the story behind the market price action. Okay, you can quickly locate levels to do business and basically ignore everything else. Okay, and that takes a lot of the stress. Okay, a lot of the you can only focus for so long. Okay, and so if you have the ability to say, well, I can sit back and relax for a while because I'm not in any area that I want to do business at, well, that actually gives you an edge, okay, in terms of taking away fatigue, taking away stress, allowing you to relax. You have the edge, okay. Most retail traders, that example that I showed you, they're looking to take the breakout. Hey, we're in an uptrend on the S&P. Look, we're approaching yesterday's high. Hey, I'm going to get long here because we could break out to new highs, and what happens? The bottom fell out of the market. All right. Obviously, from what you've seen today, you can enter the market with certainly greater precision and do it with greater confidence, and avoid the stop losses, particularly where you get stopped out with only 1 or 2 ticks, and then the market goes your way. All right. Know where one side of the market has committed in a big way, and where aggressive buyers or aggressive sellers or big buyers or big sellers are in the market and maybe getting caught upside down. So again, why are we doing this? Of course, we want you to buy the NOFT. We believe it has great value, and from what the people who own it say, it does. And our objective is to train traders to consistently and properly manage risk and trade profitably using order flow. The NOFT is the means to that end. For those of you that are ready to actually become a professional trader and trade in firm capital, we have the capital backing and the bank through which we're launching our prop firm. And so basically it comes down to how serious are you and where you want to go. If you want to trade on your own, that's great. We can help you with that. If you want to become a funded trader, we're here to help you with that process as well. You have nothing to lose by trying the NOFT and everything to gain in your trading. You'll stop missing out on those key market clues and cues to actually take action. We've got payment through PayPal, and in our members area, you've got over 30 hours of video. There's a PDF quick start cheat sheet. We've got tech support through Ninjacators and additional help through myself and Kai. lifetime membership, okay, $34.99, that entitles you to all educational upgrades and all future upgrades of the toolkit. And I'll just quickly show you the members section because we have updated that as well. Just one moment. Anything else you want to add, Kai, before we wrap up here? We'll be done here in 2 minutes. Okay, so here's the members section. All right, as I said, we've got over 30 hours of video. If you come into the members section, there's a little welcome message. If you go to video library, we've got over 30 hours of video in there, and this member section is completely updated and new since January. So you've got all the videos in there: how to find your homework levels, advanced product education, first steps with the toolkit, institutional order flow basics, getting an edge, etc. If you go to NOFT tools, this is actually a very cool section. Shows you the first steps, how to get started with the toolkit. Okay, and it also, now we've got, so here's all your first steps, how to set it up, right? Okay, and then we've actually got videos now on every single indicator. So I haven't gone into every single indicator today. There's no need to. It's kind of beyond the scope of what we're doing today. But every single indicator is in here, okay? And any that aren't are being added in short order. So that's the member section. We've got, as I mentioned, PDFs, and different filter settings for different markets, templates. They're all in here, okay? So that's your members area. So hope you guys have enjoyed the webinar, and
I can
hope to
just
see you
also,
on the other side as members.
I can also add that every week we do an introductory FAQ for new owners, and that will be any of the questions as far as setting up and what does each of the indicators do, and that particular purpose for it. And that's every single Tuesday at 4:30 p.m. So by purchasing now, you can get on board for tomorrow, and we'll get you up and running. And then there's going to be the advanced trading group that's going to be available, and that is where you can elect to be tracked by our tracking system, and that means that you will be involved with the advanced trading, and that's the advanced training towards the prop firm. And so that is the proprietary trading group that's funded, trading out of a German bank, and that's our opportunities for those that are, of course, understand the advantages that the NOFT show you, that the risk, it's all about risk management when you're trading professionally. There's very strict requirements, and so we will work with you in the advanced trainings, and that is available for the additional $250 a month, and again, that will track and give you the opportunity to be funded. But of course, you have to be fluent in the order flow sequence tracker, which is the main engine. Okay? Well, thank you very much, Jay, and thanks everybody for joining. And this is being recorded, and we'll put it out on YouTube, and hopefully we'll hear from you then. Thanks, Jay. Thanks, everybody.
Yeah, thanks everyone. I've just put up the order page there. You've got all that information in the chat as well, and the order page also shows you some of the indicators, or goes through what the indicators are, and also you scroll down to the bottom there, and then you can order that. Okay. All right. Thanks everyone. Thanks, Kai. Take care, everyone. Bye for now.